GameStop, the Internet versus Wall Street. In early 2021, a struggling video game retailer became the center of one of the wildest stock market events in modern history. What started as a niche discussion on Reddit turned into a financial chain reaction that shook hedge funds, embarrassed brokers, confused regulators, and turned one retail investor into an internet legend. This is the story of GameStop, the short squeeze, and Roaring Kitty. And to understand why it exploded the way it did, we need to start long before the headlines. GameStop was a company most people knew, but many investors had stopped believing in. It sold physical video games, consoles, and accessories through malls and shopping centers, while the world was moving quickly toward digital downloads and online gaming. To a lot of Wall Street, GameStop looked old, weak, and headed for decline. That kind of belief creates an opportunity for a particular kind of bet, short selling. Short selling means borrowing shares, selling them now, and hoping the price falls so you can buy them back cheaper later. If you're right, you make money. If you're wrong, the losses can become huge. By early 2021, GameStop was one of the most heavily shorted stocks in the market. CNBC reported that more than 38% of the company's float had been sold short, which meant there were more short positions than actual shares readily available to trade. That made the situation dangerously unstable. Meanwhile, on Reddit, a community called Wall Street Bets had developed a reputation for loud, chaotic, highly speculative trading talk. The forum mixed jokes, screenshots, wild predictions, and a very specific kind of internet bravado. But underneath the memes was a real edge, thousands of people talking about stocks in real time, sharing ideas faster than traditional finance ever could. GameStop became a target of attention because it was easy to understand. It was a company people knew. It had a visible brand. It was heavily shorted. And some users on Reddit began to think that if enough people bought and held the stock, they could trigger a short squeeze. A short squeeze happens when a stock rises so fast that short sellers are forced to buy shares back to cut their losses. But that buying pushes the price up even more, which forces even more short sellers to cover. It becomes a feedback loop, and once that loop starts, it can move very fast. At the center of the early bullish case was Keith Gill, better known online as Roaring Kitty and Deep Fucking Value. Gill had been posting about GameStop before the explosion, laying out why he believed the company was undervalued and why the market had become too pessimistic about it. What made Gill unusual was not just that he was bullish, it was that he was visible. He wasn't a hedge fund executive behind a polished report. He was a retail investor speaking in public, showing his thesis, and sticking with it over time. For many people online, that made him feel authentic in a way Wall Street rarely does. His presence gave the movement a face, and eventually, a myth. To supporters, he looked like a guy who saw through the noise. To critics, he looked like someone fueling dangerous speculation. But either way, he became the symbol of the entire saga. The buying pressure started building in late 2020 and early January 2021. GameStop announced changes to its board, including the addition of Ryan Cohen, which added even more attention to the stock. Then the price started moving, and once the move became visible, more traders jumped in. At first, the rise looked like just another volatile market story, but it quickly became something else. As more people bought shares, the stock climbed higher, and short sellers began feeling the pressure. The squeeze was no longer theoretical. It was happening in real time. GameStop shares surged wildly through January. Trading was briefly halted at moments because the moves were so extreme. By late January, the stock had reached a pre-market high of more than $500 at one point in the broader frenzy, and earlier in the week it had already posted huge intraday swings. This was no longer just about one company, it had become a cultural event. Social media was full of memes, rocket emojis, diamond hands, screenshots, and people saying they would hold no matter what. Some people truly believed they were making a statement against the financial system. There was also a sense of revenge in the air. Many retail traders felt that Wall Street had spent years making money off ordinary people, and GameStop looked like a rare chance to flip the script. For some, it was about money. For others, it was about pride, identity, and frustration with the system. Hedge funds that had bet against the stock were suddenly in real trouble. One of the most affected was Melvin Capital, which took heavy losses and needed a major cash infusion from other firms. That detail mattered because it showed just how powerful the squeeze had become. This was not a small disruption. It was a real blow to professional money managers. Then came one of the most controversial moments in the whole story. On January 28, 2021, trading platforms including Robinhood restricted buying in GameStop and some other heavily traded stocks. People who had been buying the stock suddenly found they could no longer add to their positions in the same way. For retail investors, that felt outrageous. It looked like the rules were being changed just when the little guys were winning. For Robinhood, it was tied to clearing and risk requirements, but the explanation did little to calm the public reaction. The backlash was immediate. News channels covered the story non-stop. Social media exploded with anger. People accused brokers of protecting institutions while blocking ordinary traders. The entire episode became bigger than the stock itself. It turned into a debate about fairness, market structure, and who actually gets to play the game on equal terms. Soon, the story reached Washington. On February 18, 2021, the U.S. House Financial Services Committee held a hearing titled Game Stopped. Who wins and who loses? When short sellers, social media, and retail investors collide. Keith Gill, Robinhood CEO Vladimir Tenev, Reddit co-founder and CEO Steve Huffman, and other major figures were questioned. The hearing was part theater, part investigation, part political pressure cooker. Lawmakers wanted answers. Was this manipulation? Was it a market failure? Were retail investors being exploited or empowered? The truth was complicated. There was real short interest. There was real retail buying. There was also institutional activity and trading behavior that made the whole picture messier than the clean little guy versus Wall Street story people like to tell. That complexity is important because the GameStop story became a legend partly through simplification. In popular culture, it was easy to frame as a heroic uprising. But in reality, it was a mix of speculation, crowd psychology, market mechanics, and internet virality. Keith Gill's role was also debated heavily. Some people saw him as a research-driven retail investor who shared a strong thesis. Others accused him of fueling a pump-and-dump style frenzy, though that remains controversial and legally tangled. The fact that lawsuits and public scrutiny followed him shows how influential he had become. What happened next proved the story was not over. The stock collapsed from its highs, as extreme moves often do, but GameStop had already become something bigger than a normal trade. It had become part stock market event, part meme, part online folklore, and then, years later, the ghost of the old frenzy came back. In 2024, Keith Gill resurfaced on social media after a long absence, and GameStop shares surged again as the market remembered the old meme stock energy. When Gill returned to YouTube in June 2024, the stock reacted dramatically once more. Even though the renewed rally was not the same as the chaos of 2021, it proved that the GameStop story still had power. By that point, GameStop was no longer just a retailer. It was a symbol of internet-era investing, a case study in short squeezes, and a reminder that markets are not just numbers. They are also stories, emotions, communities, and beliefs. And there is one more important angle. The losses were real too. In Sweden, Finansinspektionen later said that Swedish investors lost about 72 million kronor in connection with the GameStop affair, showing how far the hype spread and how expensive the lesson could be. So when people talk about GameStop as a victory, they are only telling part of the story. Yes, it challenged Wall Street. Yes, it changed the conversation. Yes, it made a private investor famous. But it also showed how quickly excitement can become dangerous and how fast online communities can turn investing into a global event. In the end, GameStop was not just a stock. It was a warning. It was a protest. It was a meme. And for a few unforgettable weeks, it was the center of the financial world.